it just cracks me up how quiet this still is. You go pull up a chart of the last year and a half of Chinese tech versus U.S. tech, and I mean, it's throttling it.
Yeah, it's not close.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I'm joined as always by the brain trust himself, Mr. Chase Taylor. And lucky for you guys, we're having an incredibly topical, fascinating discussion right before we started. So we're going to continue it on here. What I was explaining to Chase was the nuances of teaching my fifth grade football team a game on defense. Run a little 4-man against 3-man game here, little blitz package in the middle. Back in the day, used to call it a 46 in and out, where you stack your tackles right over the top of their guards, and you stack your inside backers right behind the tackles. And we've got two really good DNs, so that the tackles cannot help the guards on the block. So basically, you've ISO'd 4-on-3. And you have in and out calls. So when you call an out call, defensive tackles scrape B gaps. And guards go with them.
Linebackers.
Yeah, right through.
Yep. And
then you do the opposite. And I almost feel guilty doing it in fifth grade because there's no way they're going to stop it. But I don't. Yeah, so we put that in there.
The quarterback better read that and do something about it. That's at the end of the day.
Well, if a team does that to us, we have an audible for it. But most fifth grade teams do not.
What is the audible? Like a very quick pitch out or something? Or?
Well, so we've got two, but the coaches determine so I tell them what's the audible that's on the table. But the first one is if they're blitzing, if they're walking up the inside backers, then we have a Ringo call where the quarterback just audibles Ringo. That resets the snap count. And then it tells our two running backs to come up and fill A gaps.
Okay.
And then he drops back. We release our tight end down the seam. No, tight end runs a 5-yard dig, just really short relief route valve. And then we release our wing back down the seam. So the safety's got to make a pick. And, if you're blitzing your inside backers, the middle of the field's wide open.
Yep.
So
a little dig route could go to the house, even though it's a
100%
conservative route. Yep.
100%. It's so funny doing football. I feel like every coach, even if you coach at the college level or whatever, I think you should go back and really get into the nuts and bolts of coaching young kids, because it in a weird way it teaches you part of the game that you have
to go back to first principles.
Yes, and you really have, and it helps you see it better on a more sophisticated level too.
Right.
It just solidifies some things. Like for instance, like designing plays. There's been so many times where I design a perfect play, but the other defense isn't sophisticated enough to actually take the bait, right? So it's like, you know what I'm saying?
It's like playing poker against a beginner. It's really hard, actually.
Exactly. Yeah, it's really hard because you're sitting there going, okay, they should fold. They just don't know it.
You always come up with what they should do's, but when you're playing against someone that doesn't know how to play, it's actually brutal because they don't do the should do's.
Yeah. Yeah.
So I think that's very common in high level sports where everyone's working on the shoulds, and every once in a while, you got to throw somebody a crazy curveball.
Yeah.
Yeah,
you got to make it look like, well, especially at this age. And
like nobody fakes a punt from their 9. Hey, maybe you should every once in a while.
You know what? That's a really good idea.
Yeah.
Oh, that's interesting. Yeah. And especially at this age, because a lot of little tricks like that work,
Well, according to the South Florida game the other night, the tricks work against Boise State because they totally fell asleep on the backup quarterback coming in as punter. And then he just torched them
against
Boise
State.
It was just obvious, yeah.
And they didn't pick up on it.
And South Florida smashed Boise,
really,
them. Yeah, crazy.
Wow,
I wasn't upset to start the year.
Was Boise State ranked in the top 25?
They were 25, yeah.
Wow. Well, they don't have Ashton Genty anymore.
And South Florida housed them. I mean,
wow,
took their lunch money.
Well, I mean, they're that's a blue blood program, South Florida.
Yeah,
I don't even know where that is. I mean, assuming it's in South Florida.
Tampa, yep. They actually play in the Buccaneer Stadium.
Oh, okay.
Yeah,
that's kind of a bummer.
I lived in Tampa for like 6 months, and I went to some of their basketball games.
Okay. Well, you were hard up.
Yeah.
What are you doing tonight? Going to a South Florida basketball game.
I'm not a real social guy if people haven't figured it out.
Oh my God.
Going to a college sporting event by myself is that's about it.
Yeah. And yeah. I was like, don't get me going on this guy's lack of socialism. Anyway, like you give introverts a bad name.
That's true. 99th percentile introvert right here.
Yeah. Isn't that right?
True story.
All right. So on to actual events here. Yeah, I know I could sit here and talk football all the time. So, I mean, it is. Coaching in some ways as a coach, it's more obsessive than even when I played.
Oh, yeah. Because the control freak in you. I mean, now you have control over 22 pieces on the chessboard instead of one.
Yeah. No, it's a lot. And it's a lot of fun. And watching the light come on when the kids get it. That's just my favorite. And then, they walk different. They got a confidence. They start, it's just cool. I love seeing people succeed. It's fun. Anyway, okay, moving to markets. Give us a rundown on the markets.
Good timing. We filled football until the market closed. It was perfect.
Oh, I wasn't even trying to do that. But there you go.
S&P closed down 0.64. NASDAQ 100 down 1.17. Small caps down 0.44. Equal weight was barely down. Mag 7 down 1.4. All world XUS down 0.46. And that was despite the fact that the dollar was down 0.14. Oil down 1%, just under $64 a barrel now. Gold up another 1.2. Silver up 2.9, and you're pushing $41 now on silver. So,
which is
pretty strong move.
Which would be the highest close on silver since 2011, 14 years ago.
Boom. And that's kind of what miners are doing these days, finally hitting those like 2010 area.
GLD is at
and GDX closed up 2.93 on a day. The S&P was down 0.64.
Gold set a new all-time high on the day, intraday anyway. I don't know if that's the highest close. 13, I think it is. 1318, 318. Well, it is for GLD, the ETF.
It is for gold futures as well.
Okay. So,
yeah. Well, the highest close, you spiked above this on some crazy thing, but
yeah, but highest close.
Yep.
The other interesting thing about that is that whenever you see a spike above, like the crazy one, where then whether it's a stock or a metal gives that up, right? But then battles back over the next month or so and reclaims that.
Yep. No false tick, right?
That's kind of a big deal.
Yeah.
I mean, at every opportunity, the one thing I'll say, look, I will still hold to it. I'll be shocked if we don't retest 3,000. The one thing you got to say for gold, it's behaving about as strong as a commodity can. I mean, it really is. Yeah. At every time where you've been like, okay, maybe this is the weakness here. Not only is the weakness not materialized, it's responded in the opposite way.
Yeah. I mean, it's acting like the dollar's going down and we want it to go down more with some inflation and some cuts, Yep. Yield land a little interesting with the 2-year was basically flat, but the 30-year yield up 5 basis points on the day. So that's a pretty decent move higher.
What's
it's not breaking out of its range or anything, nothing crazy. It's 493. So it doesn't really matter until it's back above 5, but still 5 bips today is 5 bips today. And that's on a day with the market down. You know what I mean?
Mm-hmm. Mm-hmm.
So you didn't get much help from TLT, to hedge your SPX today. Point I'm trying to make. Granted, month end gets weird, so who knows? But vol ended up about 2% on the day, so not really that big given, decent downside, at least, for tech stocks. But
that's all it was up, was just 2%?
Yep.
Wow.
I'm sure SPOT VIX was up more, but
SPOT was up like 6.5%.
But since you can't buy that, I don't talk about it.
Another interesting one, and again, I mean, if you've been listening to our show, I feel like it's the worst kept secret ever. Alibaba popping 13% because all of a sudden the world realized, oh, Chinese tech can do AI too.
That's basically the story. Yeah.
Yeah, and you can buy it at 16 times earnings. What a novelty.
Right.
Again, not a recommendation for anybody. I mean, look, we've been wrong plenty of times, and everybody that's listening knows I'll completely eat it and acknowledge it if I am. I just look at Chinese stocks right now, and it seems like one of just the easiest plays out there right now.
Yeah, I mean, this is a great. What I'm about to describe is obviously a first class problem, but my only real fear is, I mean, other than weird policy stuff blowing up the trade, is it turning into a bubble, and getting to the point where, like, I don't know. In fact,
but we're so far from that. You and I were talking about that this morning. I mean, The difference in this market is that in 3 weeks that could completely change. You know, with the way this market
Right.
moves so fast. I mean, we could feel like it's way overbought and bubbly in 4 weeks. The way this
and
market,
when Chinese investors get excited, they
goes
they
fast.
make things go up. So you never know. But at the same time, like policymakers have been adding a lot of, like their economy's sluggish. It's just that they've added so much liquidity that it's really fueling it. And then there's that TINA thing we talked about yesterday. You know, I would assume if it gets really going, then you know they pull back on the liquidity, and then the state buyers go from buyers to sellers. Like they can sit on it if they want to, but maybe they don't want to too badly yet.
Yeah. I mean, it just cracks me up how quiet this still is. You go pull up a chart of the last year and a half of Chinese tech versus U.S. tech, and I mean, it's throttling it.
Yeah, it's not close.
And then you look, like I said,
it's not just tech. We talked this morning. Like the chart that looks most bubblicious that I have from China is the small caps.
Yeah.
So
yep.
That thing's just gone straight up lately.
Yeah. No, it's the other thing too is I'll continue to say I was just messaging back and forth with Parrot Capital. You know who he is?
No, I don't.
The Parrot. Anyway, he puts out good stuff. We were just chatting before about, like, you know, he's referencing, he retweeted Iggy Azalea is becoming, for those of you that do not know, she's a rapper, pseudo entertainer, whatever, like celebrity type person of some kind. Anyway, I guess she's becoming a crypto entrepreneur.
Naturally.
And he was like, the top's got to be close. And I responded and I go, I think it's happening now, man. And I just said, like, maybe not, but it's not a one bet game anymore, meaning it's not just tech going up. And I just said, look, I think I'm seeing bids coming into international. I'm seeing bids coming into value like I haven't seen in a very long time. Yeah. A very long time. And you know, we're not just, I mean, we've been preaching that same story since the beginning of the year. And it's one of those things where it sounds like you're making a bold call, but then you kind of look around and look at stuff, and I don't think it's a bold call at all. I mean, if you think that buying things cheap and watching them rise to a level that they actually, the price makes sense to the right? If you believe in that style of investing and that works pretty well, you know, buying things cheap. I don't really think you got a whole lot of options. I mean, it seems just very obvious.
Right.
And then you see kind of a tale of two earnings here. And I think this, not a perfect comp, but here's my pitch. If I was going to give an elevator pitch for international, here's what it'd be. Look at the earnings announcements and the stock reactions from Alibaba and Nvidia. Okay. You've got one company that had a great quarter, right? Did great. Stock's still down a little bit because of the forward guidance. Then you dig into price versus sales. And then you start digging all that stuff and you're like, it's really hard at this price level, especially considering the action on the stock and what the stock has done over the last 12 months and even year to date. It's kind of hard to come up with a investment thesis that you feel really confident about Nvidia right here at this price going forward, right? Like, what else is going to propel that stock, given what we know, what's on, you know what I mean?
Right. Especially for like that next 3 to 6 months or whatever. Like,
right. Then you flip around and you look at an Alibaba who, quote unquote, had a disappointing quarter. Now, I always laugh at that statement. Good quarter, bad quarter, disappointing, happy, right? Because Wall Street's definition of that is different than what yours and mine is. And it's different than what 98% of people would think a good or bad quarter is, right? Meaning, whether you have a good or bad quarter or not, it has a lot to do with the state of your company. It has a lot to do with where the stock is currently trading.
Yeah, and sometimes, like, house cleaning you badly need to do this for the good of the growth of the company, it creates a bad quarter.
Right,
so
right.
Like, and vice versa.
So conversely, when I see a company, here's another thing, man. When you see, now I don't think that this qualifies as bad news. I think it just qualifies. I think it's called bad news because this market's stupid. But when companies rally on what's supposedly bad news, That's like one of the most bullish setups out there ever, right? Because what that's typically telling you, and I do not know that this is the case with Alibaba right now, so grain of salt time. But what it's telling you, for the most part, is that all and every potential bit of bad news has been priced in. That investors are like, okay, the bottom's in. You know what I mean? And then, like I said, then you go look at the valuations. Then you look at what they're talking about in AI and cloud and this other kind of stuff. And then again, you go back and look at the valuation. You're like, yeah, I got to buy that. You know what I mean? Asia just looks really good. It just looks really good.
Yeah, could not agree more.
It reminds me, it's funny though, you said you're worried about it getting published. I remember us having the exact same discussion about oil toward the end of 2020, where I remember the words that were said. It was, man, what are we going to do with our portfolio when this stuff gets fairly valued? Because we were so excited about it, because you're buying $100 bills for $10.
The funny thing about that is, in investing, a lesson that everyone should learn is like, it's kind of like being at a bus stop, but the buses don't stop coming. Like the opportunities never stop coming. But I know for me, every time I find a really good trade, I get like an existential dread over when that trade ends.
I know.
Like, what am I going to do next?
I know. I feel similar to gold miners and stuff like that right now.
Like after that, then what?
Now, I thankfully, my outlook for gold miners, I think we have a lot ahead of us, and I think it's going to be a longer run. But I mean, every dollar that gold goes up, it complicates that trade a little more.
Right.
I mean, it was a lot. I felt more comfortable buying GDX with $2,400 gold and GDX trading at 34.
The beauty of that stuff is like the sentiment really helps.
Yeah.
And a perfect example is if you remember oil. Do you remember you couldn't listen to a podcast or read a piece of research without someone talking about $200, $300, $400, $500 oil. Like that's when you know, like, okay,
it's over big.
Like we just went from negative to like it's going to 500. You can have it back.
Yep.
And the beauty of gold mining so far is like no one wants it. Like people have been selling most of the year. People have sold the ETF as it went higher. So like that tells you like, okay, we have runway. Same if I look at most ex-US stocks, like we had a little period where people really started piling in to emerging markets, just kind of writ large, but like there's no giant inflows and sentiment around China, like not there.
That's why I like it.
And yeah, once you get that, that's when you're like, all right, well, we got to give a bunch of it back or all of it back and find something that people don't like again.
Yeah, no, it's yeah, I'm not looking forward to that trade catching on. Just
same with Google, right?
Yeah, now you see
still
Google
nobody likes it.
Well, and I'll go back to the old one. And again, when I'm wrong, I'll admit it. But I took a lot of flack on Twitter over the gold miner call, and a lot of guys that I really respect, buddies of ours, vehemently disagreed.
And to be clear with everyone listening, Zach didn't start on this call after it had moved up 30-40%.
No,
it was like actually in a downtrend, and no one liked it whenever you made that call.
Yeah.
You deserve credit for that.
Yeah, thank you. That was a lonely one. Which to go to your point though, it doesn't mean you're right. Those are always the setups where you make the most money when nobody agrees with you. And I'll just go back to it because I've said it before, but I'll say it again because I think it bears repeating. Whenever you hear when the last reason to not buy a sector is the acknowledgement that profits are going up and still nobody will want the stock, I hear you. I'm not saying that it's never happened, and I'm not saying it can't happen again. What I am telling you is in my career, that has always been a dinner bell to back up the freaking truck. I'll also tell you that I've never backed up the truck enough in that scenario. And I probably never will, just because you can't
risk
be
management.
Yeah. But it's the operational leverage. And it's funny to talk about energy stocks because some of the same dynamics are in play that drove them, which is, look, guys, you can have there are examples of companies whose profits go up for a period of time and the stock doesn't rally because the market doesn't believe it's sustainable or anything like that. Okay. But then there's scenarios where companies start making levels of profit that become transformational, right? We saw that in energy so many times where you're like, okay, you may not like energy stocks. That's fine. But those stocks are going to go up. And the reason they're going to go up is because they're cash flowing enough to have all of their debt paid off in the next 16 months. And as long as oil stays above 50, they're going to have enough cash to buy back 10% of their float every year. You know what I mean? Where you're just like, look, you may be right about investor sentiment, but they don't need investors to jack their price up. They got so much cash coming in. Oil company or gold companies are in the same position right now, which is, it's not that profits going up incrementally. They're looking at record net margins, right? It's raining money. They don't know what to do with it all. And when you get a scenario like that, you're going to get stock buybacks. You're going to get special dividends. You're going to get asset purchases of other assets, right? There's so many other things. And the other thing I'll tell people that think they might be late to the gold story, look, you know, when you know, there's a couple signs historically that you're late to the gold story. First of all, you start watching old garbage properties that have problems getting recirculated and selling for too much. And you sit there and go, and you see it every cycle, right? The other thing that you see is, you know, which always happens in every bull market, but you see people extrapolating out valuation and you see them putting huge values on reserves in the ground. Okay, you go look at these gold companies. I can't find one that's valued in such a way that on the surface of it includes the metal they've got in the ground.
Right.
Every one of them looks dirt cheap on a traditional price to earnings ratio, right? But that's not really how gold companies should be valued. The reserves in the ground shouldn't be valued at current gold prices. I'm not saying.
Yeah, because it turns out it's hard and expensive to get.
Yes, it is. Okay, but at the same time, not even having it in the
right.
That makes zero sense, right?
It's like they all trade on just on the kind of like operations and the current production versus like the potential production is just like, who cares?
Yeah, they trade they're like they trade like they're like a janitorial stock growing at 2.5% a year. You know what I mean? Where you know, just, well, I own it for the dividend.
Yeah,
you know what I mean.
Hey, that sounds like a nice little cigar, but I don't know.
Yeah, hey, it could be, especially
if anyone has any janitorial equities to tell us about.
Yeah, I mean, maybe find one with like a monster yield or something like that. So what did we get that? Didn't that company that we bought that trade finance company didn't have like a 13% yield when we bought it?
I do not remember.
Something stupid. It was above 12. Had to be.
We've had a few double-digit ones.
Oh, I might be thinking of the Nat Gas company. That one was that one was yielding over 13. Yeah, that was silly. And I remember looking at it and this goes
not going down every month or anything either. So
right, no. Well, then you look at it and you're like, you know, you're sitting there going, okay, you're breaking something down like that, and you're like, okay, what I'm going into looking at this company, thinking to myself, okay, where is the hair? And I'm hoping that the hair has been overstated on this thing, and that's why it's yielding that. You go look at it, and there's no hair.
They just give all the money back.
Yeah, there's no problem with it.
Right.
And this market's like, yeah, no. I'd prefer 13% revenue growth. I don't want 13% yield.
Right.
And
you're
like,
very, very calm.
You're like, okay, so let me walk you through the math on this. But you know, it is what it is. Couple other things. I left my show sheet out there.
Well, I got something I want to dive into.
Yeah. What is it? Chris
Waller gave a speech yesterday, which I think is important for like 100 reasons. But I'll talk about a couple. First of all, it's a really good speech. Anyone out there that's like a nerd, they should check it out. But I've been trying to figure out how some of these people are super dovish, other than the obvious. Like, he's made it clear, you know, he's very worried about the labor market just going, you know, pear-shaped real fast. And I think that's a valid concern. But you know, for me, I'm worried about inflation. So every time I see this, I'm like, how are they just not worried about inflation? But he shed some light on that. And he basically said, and he shouldn't have put these times on it in my view, but he did. And he said he saw like a couple more months of like this inflation pressure and the monthly inflation stuff. And he expected the tariff inflation impulse stuff to dissipate by early 2026. So when I heard that, I was like, oh, well, this is why he's wrong. Like, he thinks tariffs are basically like a 6-month story. Like that just blew my mind. I think that's going to be very wrong. And I do think that's important because if that's wrong, I think he'll see that eventually and be like, oh, well, I was wrong. I changed my mind.
Well, a statement like that kind of gets me excited. And the reason it gets me excited is I sit there and I'm like, okay, I'm about to learn something one way or the other, because from my point of view, I think that's when you're finally going to feel the full weight of them.
Exactly. To me, they don't start hitting until the exact time he expects them to stop hitting.
Right. Because the other thing you got to consider is our timeline might be a little aggressive, may take a little longer because the inventory stocking that so many people did in preparation for.
And how much of
tariffs.
this is in the early and the middle stages of our supply chain, not at the end.
Right.
So it has to pig in a python through, it's got to go through the garden hose for, I think some of this won't hit for 2 years, but, so I found that interesting. And then he also said the same thing as Powell, which is like, hey, like, long-term inflation expectation stuff is like, it's fine. So I don't have to care about this because of that. And he's not wrong. Like if you look at the 10-year inflation swap, 5-year inflation swap, they're not high. It's nothing to freak out about. But the 5-year inflation swap is at a 2-year high.
Oh, yeah, but this is also at a period of time, and I'll counterbalance it. I don't think that this market has been this inefficient in our lifetime. Meaning, like I'm not going to say, look at the 5-year swap, and I'm like, look
at it in 2020.
Yeah, and look, well, yeah, that's a great point. The other thing is guys, this drives me nuts to no end with central bankers. Okay, they've gone in there and via quantitative easing and all the other stuff that they've done, they've gone in there and messed with this stuff so bad. The truth is, we don't know what those rates are. Like interest rate land is not what it used to be. And then when you hear those same guys like point to the market and go, well, the market's telling you everything's fine. No, the market's telling me what you want it to tell me, right? Like, and you guys say that. Operation Twist. What is the long end of the yield curve? Up until now, it's what you want it to be. Where it used to be a market indicator, it told you something, right? That's why yield curve inversions mattered, right? It was telling you that money is moving in a different way all of a sudden, and that usually means something. The problem is they've muted out all those signals. And I'm not saying that there's been zero reason for them to do that and that they're nefarious and they're bad or anything. I'm just saying, like, if any central banker looks at a market indicator like 5 or 10-year swaps and tells me that means something, I'm going to look at them and go, thanks to you, it means nothing. We don't know what they are.
With that said, I do think if the private sector was really worried about inflation, people would be bidding that stuff up higher than it is now, for sure.
Oh, I agree. Yeah. But I think, in my opinion, I think the perception of inflation is just wildly wrong.
Right. I think people look at, it's like an echo chamber where you look over at yields and you're like, well, they're not that bad. And you look over at, you look at everything else and like, oh, hey, no one else is worried about the monsters, so I'm not going to worry about the monsters.
Yeah. Well, I mean, and that can get us into, Trump taking shots at the way that the CPI is calculated and all that kind of stuff. I mean, I would just sit back and ask people, hey, you guys are all paying prices. Right. According to Fed CPA data, they would tell you that inflation is up, 28% since the beginning of 2020? I don't know of anything that's only up 28%.
Yeah.
Right? Like, so we know that's nonsense. And again, I'm not saying it's totally contrived and totally nonsense. I just think the way that we look at inflation is purposefully understated.
Right. It's clipped to some degree.
Yes, 100%.
And not in some crazy, scary.
No,
we're trying to like get one over on you, but yeah, like the incentives are there to just at least clip it a little bit.
Yeah, nobody wins from higher inflation.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
And not only did he put himself out there with this timeline on inflation coming from tariffs, but he literally said, I'm not kidding. He said that he is on team transitory again. So like he went there and said he's on team transitory. I just thought, talk about risk reward. Like the upside for saying that is so low compared to the downside of saying that. I just thought that was crazy. But
here's the other.
He may be proven right. Like, and his argument is sort of like, hey, the tariffs are going to hurt the economy. That's going to bring down everything. And like, so yeah, like growth will be bad, jobs will be bad, inflation isn't going to get that bad. He may be right, but still, like, why would you go out of your way and say I'm on team transitory? I don't know.
I just think that the risks, I think I'm not 100% sure they're wrong. What I think that I feel very sure of, and it kind of sucks because you'll never have a way of bearing this out or proving it. What I do think is that the inflation outlook is much more balanced than they're making it sound. Like, meaning,
oh yeah,
the thing looks like it's a teeter-totter balance in the middle, it could tip either way. And the reason I say that is, look at all the things going on. You shouldn't have inflation data where it is right now, and it hasn't even been hit by tariffs yet.
And it's 3% and rising roughly, and after 5 years of being above target. That's why like they're being so sanguine about
Well, and Chase and rising.
right. They're being so sanguine about it bothers me about the expectation part bothers me the most because expectations aren't the same. Like the driving force behind them isn't the same now as it was in 2020 when we had inflation for 20 years. So like now we've had it above target for 5. So people are gonna be twitchier about it. You're not gonna be like, well, this will probably go away. It always goes away, right? And now people are gonna be like, this has been with me for 5 years and now it's going back up. Like my expectations are now they are higher. Like
Yeah, and I think a lot of that is behavioral again, meaning I think people sat there and went, "Well, we've seen the worst of it so far." There's this baked in, and you won't hear people say it audibly, but you can listen to what they say, listen to them talk about home loans, listen to them talk about rates, and there is this baked in belief that's kind of like Voldemort, right? It's like everybody kind of sees it, but nobody really says it out loud, which is, well, yeah, but things have normalized now, so naturally rates are going to go back down. And you look at them and go, guys, normal is above where we're at, historically speaking.
right.
Like you're getting the exception mixed with the rule here, right? We were living in the exception for the last 15 years, not the rule. And I think that's going to catch a lot of people off guard. And I don't think in a world where you're running 7% deficits, where you've got 130% debt to GDP, I don't think you're going back to 0 rates. I just don't see it.
And if you do, it would be not because you should have. It will be because you're just trying to, because of the fiscal dominance. You want to get those interest costs down.
The other thing too, you got to ask yourself is, would the market response be the same? Meaning in today's world, if you think you got a tough time running an auction at 4.9 on a 30-year, I think you might have a lot tougher time getting those bonds sold if people have to swallow 2% yields again.
And this is something I think I see this all the time on FinTwit, or just with people in this business is forecasters, macro people. They're looking at this backdrop, and I can just tell like they're not thinking about the downsides of the run it hot scenario, right? It's as if it's like a giant free lunch. Like, oh man, they're going to lower rates and do some more QE, like everything to the moon. And to a degree, that may be right, just but not on a real basis. But at the same time, like this means the cost of capital has to go higher. Now, just because the front end goes down, that doesn't mean the cost of capital goes down. And it doesn't mean everyone's going to be willing to give you money at those crazy rates, right? Like,
well,
you can look at EM when they had rates low. That doesn't mean everyone's going to give you that.
Consumer loans aren't working off the 2-year.
So yeah, and like most lending in the economy at the end of the day is past that. And think about it. If your business is to lend money and you get a really steep yield curve and the economy gets a little weaker, or assuming it did, are you going to give people floating rate at 0? Are you going to look out at, the 30-year being at 6 or whatever and go, I need 3? You know what I mean? Like, how are you going to make money in that environment? You won't if you're going to lend at nothing. So people won't.
I got to be honest. If my business was lending money right now, I probably would not be entertaining any loans that went out further than 5 years.
Yeah. And this like whole, you could change the whole regime of like SOFR plus, because you get a lot of the lending. It's like, SOFR plus 1%,
Yeah.
Well, if inflation's 5,
give me 1.5 or 2.
Right. Like,
yeah.
Like that plus and SOFR plus in some of these lending terms changes.
Yeah. Yeah. No, that's, yeah.
So point being there, like the cost of capital cannot stay where we have gotten used to it if you're going to run inflation higher than we've gotten used to and have, like you don't get both.
No.
You don't get all the inflows from the rest of the world. It keeps the cost of capital low, like all that.
No. Yeah. There's a lot of stuff. I'll just keep going back to that whole thing of U.S. markets are really tough right now. And I just think that there is so many other places in the world that aren't, and could end up being wrong on that. But I'm having a tough time seeing how, which usually means the market's going to humble me and show me. But it's not an overconfident statement either. Like I acknowledge anything can happen.
Sure.
I just think people are being too smart by half right now. like, hey, there's a bunch of good assets out there on sale for really cheap prices. Go buy that.
Right. And think about, this, you're talking about like operating leverage. And if you think of it from a national perspective, you can think of that operating leverage as being a problem whenever your fixed cost tied to your debt is really high. That it's hard to get that operating leverage. But you think of like Estonia has like 25% debt to GDP, rapidly growing, impressive economy. Like, why wouldn't I put money in a place like Estonia, versus a place that has over 100% debt to GDP that is rising way faster. And at least in places like Eastern Europe, like if they have a big deficit, it's probably literally all going to defense instead of, to make sure grandma doesn't pay taxes or whatever.
Yeah. Yeah. There's just, it's a very target rich environment. It's just not where everybody's looking. We were even talking about that comp, and I'm forgetting the company that it got comp to, but just even stuff on companies well known. Like you take a look at a company like Snap. Snap's trading at 2 times revenue and growing at 17, 18% a year still, right? Stock-based comp's a little out of hand, but a lot out of hand. Yeah, but I think a lot of conditions in the tech industry are probably going to alleviate that pressure on them, right? Meaning, all of a sudden there's a lot more coders that need work, which means less competitive comp plans. I got to believe that Snap understands that
there's more eyeballs on it than there was 2 years ago. More
people aware of that issue. But, the other company that they were comparing it to, they had a ton of stock-based comp too.
Right.
And that's what I was telling you.
Yeah, even within tech, you can find stuff that doesn't make sense.
Yeah. When that's the other thing I was telling you that we were discussing this morning, which is that to me is the craziest part of this whole market. I've seen bubbles before. It's the lack of uniformity that's just shocking, where you see companies in the same sector doing relatively the same thing. And you look at growth rate, and if you really want to be puzzled about how stocks are valued, go start pulling up similar names in tech. Look at their growth rates, look at everything, and I try to come up with why certain things are valued where they are. Right? Start with Apple and Google, then go to Snap. And what was the one it compared it to? I'm forgetting the name of it.
I don't remember either.
God dang it!
And I think the easiest way to do this is with like really simple companies. So like, home builders or
airline companies, like we've talked about.
We talked about airlines, like automakers. If you just make cars, that's what you do.
Yep.
And you can find, just take, a basket of 2 or 3 in the U.S. and then go find some around the world. And then break it down to like the most basic metric levels of like, revenue per car sold or whatever like that. And then the valuation per car sold, find a way to equalize the numbers in a way that makes sense. And you can do this with any like simple industry. And then you compare like the US names versus the rest of the world names. And it's like, whoa.
And it's typically like, again, this isn't a rule, but it's not small. You're typically talking like 3 to 5x.
It's orders of magnitude. It's not, it's not like an 8% difference or something.
It's just shocking. And the reason we bring up airline companies, and we've brought this up before, but the reason you bring up airline companies is with some very small differences. It's really tough to find an industry that, regardless of where it's located around the globe, it is what it is, right?
You just move people through the air in a tin can.
Your biggest costs are fuel, right? Like your biggest costs after fuel are going to be labor, pension liabilities, right? They're all the same, right? They also all use exactly the same equipment. So NAV calculations are a lot more handy there, right? Like meaning, there's a lot of companies where you and I were talking about it. You could have a totally legit audited NAV number. And yet, if you wanted to go liquidate that company's assets, you might get 30% of the stated NAV,
right?
Depending on the specialty of the equipment, all that kind of stuff. Okay, that ain't the case in the airline industry. Every asset they have is used and needed by another airline company, right? So when you're looking at an NAV, when you can buy a company that has positive cash flow, substantial net cash on, growing revenue, high customer satisfaction, checks all those boxes in that industry, and you can buy it at a 15 to 25% discount to NAV, assuming those calculations are legit, That's almost impossible to lose money on.
Yeah.
You know what I mean?
I've made this point before a few months ago, but like I've always hear value investors bemoan the fact that I would have done anything to have the same opportunities, that Ben Graham had when he wrote about this stuff. Like, yeah, I would love to buy something for the cash value, but like we can't do that anymore. That's not the world in 2025. The thing is, if you
Not with that attitude,
if you whip your passport out, it is.
Yeah, you just got to look
still
outside.
do the Ben Graham stuff if you're and especially if you're willing to look at smaller companies, and if you're willing to look at ones that don't have 50 stars in their flag, you'll find it.
Yeah. Now, you might not hear Dan Ives and Tom Lee talking about it.
Yeah, no one's going to talk about it.
You might not be getting a booyah scream from Kramer on it. But, and I think that's another thing that makes this time, it's another thing that probably makes the opportunity. You've never seen a market before, at least in our lifetime, where the biggest outperformers, the biggest gainers came from the top end of the index. It's always been the inverse, right? And so I think that has made people uniquely blind to small and mid-cap opportunities, especially internationally. Just because you come up with these valuations where you're like, look, one of these has to be wrong, right? You show me a extraordinarily well-respected, clean, Latin American airline company that's growing double digits, customer satisfaction, no pension liabilities, net cash, all that kind of stuff. And then you show me Alaska Airlines in that South American area, it's trading at 1/5 the valuation. One of those prices is really wrong.
Right.
And then when I look under the hood and I find out that South American company has 17.5% net margins, which is better than Apple, by the way, currently, and you're getting a 7.5% dividend while you sit there and get it. I mean, you start going down, and you can find stuff internationally like this all day long.
Right.
You start going down the list, and you quit kind of looking at it like, what do I think the upside is? And you start kind of playing a game. You're like, how can this thing lose substantial money?
Right, which is sometimes more to the point of, to me, like that was kind of the crux with like the platinum group metals trade was, sure, I thought it could go up a bunch, but it was more to the point was like, it makes no sense for this to go down much. If it goes down much, all the mines stop operating and then the price goes back up. So like you just realize the downside is just so limited.
Yeah.
Which is just as important. I know it's not to Kramer and company or financial influencers. It's not. That's just as important in real life investing as the upside.
It just hasn't paid in long enough. That's the issue, right? Like that's the issue.
Right, of course.
Right? Every chump that you've heard that's gotten unbelievable market returns is because he went all in on some darling tech name.
Right.
It wasn't because he found some hidden treasure in the trash can, which is how you came up with returns like that when we were coming up. And this market, we've been saying this for a long time. We'll continue to say it. This market dynamic that we've been living in and operating in for the last 20 years is not homeostasis. It's not normal. And
to your point, I think it's easy for young people to not realize. But if you go back to after the .com bubble, if you were, or even in before the .com bubble really got going, in both periods, if you were out buying a bunch of tech stocks, you were an idiot. And everyone would have judged you for like, why in the world would you buy that?
Yep.
Like, why wouldn't you go buy GE and Exxon and like
Boeing?
Yeah. Like, what are you doing?
Yeah.
Like
Microsoft's dead money. Everybody knows that.
It was the same as the flip side is now, where it's like, you're a moron if you're not in that stuff.
And that didn't flip until probably like about 2011. I remember when I first got in the game.
Let's be honest. It was the firefighting of the GFC with all the liquidity.
Yep.
Oh, granted, all those companies really executed.
And then you had technological breakthroughs as well. But a lot of young investors
earnings have kept up.
Hey, if you wanted to get a bunch of eye rolls, walk into an investment conference in 2007, talk about tech.
Yeah, exactly.
Like literally, you'd have gotten the same response you'd get if you went in there and talked about energy and gold right now. It'd be like,
or South American Airlines.
Yeah, or South American Airlines. Yeah. It's so, guys, everything cycles. The pendulum always swings back. And the one thing in common that losers and winners all have in common, right? In all of those scenarios, the winners are always the ones that know the pendulum swings back, and the big losers are the ones that are betting it never does.
Right.
Every time.
one edge that will never, in my opinion, leave us is that humans extrapolate.
Yep. And I think that one of the biggest keys to it, which is why I say is it's that, to me, that biggest key is that breakdown in uniformity. When that delta in valuation just gets irrationally large, when, for instance, you got airline companies that are trading at 1/5 the valuation of US, like that, you don't have to have a CFA to know that, wait a second, that just doesn't make any sense. The other thing is, if I've got a company that's growing by double digits and throwing off strong cash flow and 17.5% margins, how is it possible that that's where, and they have a clean balance sheet with net cash? It is not possible that that company's worth 80% in NAV. It's not, right? Because if it's only worth its net asset value, it shouldn't be creating a profit, right? Like the fact that it's creating a profit it tells you unequivocally, it is worth more than its net asset value. And remember, we're not buying it at net asset value. We're buying it at 20% discount.
Right. And we were talking about earlier today, like
while collecting a 7% yield.
Where Cuppy had done this with offshore names, showing not just their valuation versus, this is like in the past.
Like, I'm glad you brought this up because I think this is a good one to talk about.
A couple years ago, like making the point, of the valuation versus not just like how much can they sell an old rig for, but what is it roughly worth in just pure literal scrap value? Yep. If you were just like, take the steel off our hands, what would you give me? And you could kind of make a model off that and look at it and go, oh, geez, like the valuation versus the steel at hand was itself like mouthwatering. Right. Forget if they can sell it to someone else. Forget, if they can make some money with the equipment for another year or 5 years or 10 years. So again, like those opportunities are out there, but like you can look at the flows into the different sectors over time and for years and years. Like the flows into energy, it's just straight down, and then like obviously tech straight up. It's just, so if you get year after year after year after year of everyone just net selling a sector, well, yeah, then you end up with some names that are worth a little bit more than the literal scrap value of the stuff they have.
Yeah, and that's why it's not an exact comparison, but when we got on that gold train, there were several people we knew and that were advocating that, and all the reasons why they thought owning gold retail companies were better bets, right? Going back to your operational leverage comment, I remember hearing that and going, with all due respect, guys, it kind of sounds to me like you don't really understand the gold industry. Okay. If I think a metal is, or any product is going to go through the roof, the last thing I want to do is own a retailer of that. I want to own a producer. Why? Because the producer has operational leverage. The retailer doesn't, right? Oh, price of gold's gone up. They should make more money. That's not the way the industry works. They're getting 2.5% rips. That's what they're getting.
Right. Maybe that does expand a little bit.
Yeah, but
if you get a hungry hippo scenario.
Yeah, but I mean, the operational leverage between that and a producer is not even comparable.
Yeah, especially while oil prices are falling and labor costs are stabilizing and their balance sheets were at the best levels they've been in a decade.
At some point, I'm sure I'm going to encounter a situation where that doesn't work. Like odds are, like I'm going to encounter one where that whole, the profit's going to go up, but nobody's going to want to buy it. And when it doesn't work, I won't be glad about it. It's never fun to lose money, but I'll take my medicine just because there has been no better freaking buy signal I have ever heard is when that is the last, that's the last standing objection.
When you can prove the case of the inflection but people don't even want to hear that.
Right.
Yeah.
Yep. That's when you want in.
Right.
And then that's, quite honestly, that's probably what creates that wall of worry dynamic that we talk about. Rather than it being worry, it's just gradual attrition of bears over time. Right. Just kind of that relenting. Yeah. Right. Anyway, do you have anything else?
No, I don't.
Yeah, about does it for me too. Wrapped up. Anyway, we got some big. Do you have any data coming out next week?
Next week is jobs week, so that's a
big one.
Super big.
It's a big one,
and
especially right now.
Yeah, we've gotten to the point where everybody's convinced themselves the labor market is teetering on disaster. So, if it's kind of just meh, I think that's everyone's like, oh, maybe it's not dying like as we speak. Obviously, if it gets worse from here, everyone will freak out.
I don't see it. I don't see any evidence of that.
But if it gets better, everyone's going to have to like take a step back and go, well, wait a second. You know what I mean? Then like that.
You could also be in a really sticky situation here because if you got a hot jobs report all of a sudden out of nowhere, how do
you justify cutting? Right. With 3% and rising inflation, you can't really justify cutting if jobs themselves aren't really bad or looking like they're about to get bad.
Yeah, I agree. All right, man. Well, that does it for us today, guys. We got to run. Have a wonderful weekend. And as always, catch us on social media. You can get us on YouTube at knowyourriskpodcast.com, or you can go to or just search Know Your Risk Podcast, or go to knowyourriskpodcast.com. Subscribe, listen, tell your friends. Anyway, have a great weekend. We'll be back next week. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.